Hey traders, welcome to Charts and Coffee. Great to see everyone. Happy Wednesday. We are taking a look at the markets after we have CPI. We're looking at really nice follow through, generally in equities, right? That's what we've been talking about all year. This is what we've been talking about for the better part of a year. We're still seeing those uptrends that are worth buying the dip on, right? Every morning, there's two little sticky notes. I wish you could see them. One of these days, we'll have to do a little office tour. Very little. When we have an uptrend, there's two things on my mind. One, relative outperformers. Two, buy the dip. And the sticky note that always remains on my desk, do I hate my money? Reminding me that risk management comes first, right? That is the key to account growth. So let's get to it. Bonds are struggling this morning. So I'm going to point out a few places where we still have to be looking at the overall macroeconomic rate of change expectations from three other places other than indices, right? Bonds, we want to see the bonds remain above the 200, which they are, by the way. And, one of my favorite ways to look at moving averages is to look at the old fashioned, and it is classic stuff. I've got books that were written in the 40s and 50s that talk about simple moving average crosses. When two moving averages cross, there is a unique psychology associated with it. And that's something we can keep an eye on. That's why I use propulsion dots, by the way. Those are exponential moving average crosses. Now, why exponential over simple, Rog? So for those of you that have never thought about why would we focus on exponential moving averages, all that multisyllabic technobabble, we'll cover that in a moment, versus simple. So simple is the way that when we were in middle school, I remember doing this. I'd sit down and look at all my quizzes and tests and homework assignments, and I would just do a straight average to figure out what kind of grade I was going to get, right? Simple moving average. We just average everything weighted equally. But we know recency bias is a thing. If you've never done any research on cognitive biases, it's very interesting, and it absolutely affects our trading. Recency bias is things that happen more recently or more, lodged in our memory. We react to that data in a more emphatic way. So why not use a moving average that's calculated with that in mind, right? That's what exponential moving averages do. That is why they're superior to simple moving averages. And you're going to get similar location on the chart. You're going to get similar reaction, but it's not about similar. It's about more accurate. And if you haven't ever tried moving average crosses with an exponential, do it or just grab the simpler propulsion tool. That said, you can see these white dots. That's where the moving averages have recrossed, right? We want things that will turn on and turn off. And that's why I love this as well. The cross turns things on and off to let us know that the environment is valid for that moving average or not. Pretty simple, yeah? All right, so as long as we're above those white dots, we're in the bullish hemisphere. And if we're in the bullish hemisphere, bond traders are thinking two main things. Jerome, you're not breaking the economy by waiting till possibly June, maybe later, who knows, to start cutting rates. And here's the other thing too, bond traders are also saying that lower rates are coming, right? So that's definitely something we want to take a look at here this morning. Where are bonds? All right, the other thing that's related to bonds are gold. All right, how many folks here have heard gold is a safe haven play? It's the flight to safety. Oh, hang on one sec. I know I still have some error somewhere here. I'll have to fix it. Anyway, if I have gold moving according to flight to safety, why is it up with the equities are up, right? These are things we have to question the logic of, right? And so if I have gold moving higher and bonds moving higher, clearly gold is not a reaction to a flight to safety. By the way, here's a little secret. It never has been. Gold moves based on something called real yields or real interest rates, which is the chasm between the shorter end of the yield curve, the nominal yield of, say, a 1 to 3 year bond, and the rate of inflation. And when that narrows, gold goes up. And that's it. So gold is moving higher, bonds are moving higher. That's a good, we want those things in unison, ideally for follow through, right? Now, if you haven't checked out, by the way, the video that I put out yesterday It is simply called account growth. I even wore my account growth t-shirt today. Account growth, gang, that is it. That is always the mantra. That is always the goal, right? Home runs. If you're watching this show, if you're watching me, this isn't about home runs. This isn't finding the next hot stock. This is just about finding relative outperformers, finding the uptrend, and continuing to buy the dip, growing your account. If you haven't checked that video out, I went into a lot of detail about win rates, losses. How often do I lose? For every 10 trades I take, I'm going to lose about 3 to 4 times. I know some traders never lose. Good for them. That always cracks me up. We want to stick with the long side. And every one of the trades that I'm showing you, and this is so far this year through March 1, everything I have done to grow the account has been a long call. That's it. A long call. Exactly, Sam. Get on base, base hits, right? Show up healthy for every game. And that's what we want to do. So base hits, right? I'm much more Cal Ripken than I am, say, I don't know, who is the big home run hitter? Whoever that is, right? So keep that in mind. Base hits, exactly. All right, so let's get into, as always, if you have any questions, feel free to type them in. All right, great. And we'll take a look at what's happening with the indices. Is it surprising anybody that we're making higher highs? Right? We're making higher highs. I know. Who knew? Who knew? We continue to be focused on buy the dip because this is an uptrend. Now, the two best uptrends at the index level continue to be the S&P and the NASDAQ, right? Now, remember, you are going to be subjected to some of the worst analysis that I have seen, whether it's on television or wherever you're finding it. We continue to have traders and analysts and economists and whatever happens on television and on the interwebs, right? Every time we have a couple down days, oh, the trend is down. No, the momentum is a little bearish, and that's a retracement. Remember the difference between a retracement and a broader base correction. I know I sometimes will use those words interchangeably, but a correction typically means we've broken the dominant trend, right? Those are going to be corrections of 10% from the high, 15% from the high, 20% from the high, right? So I'm not looking for corrections. We seldom can position ourselves for them. We might fool ourselves into thinking we know where the tops are, but rather than focusing on where the market's going to correct, we'll continue to focus on within the context of an uptrend, like in the NASDAQ, like in the S&P, retracements of the trend, which is really, from a lingo perspective, very different than the correction, right? Corrections are far more greater percentage moves to the downside that typically involve breaking the dominant trend. We have yet to even have one of those. This trend has been so strong, we haven't even seen a neutral candle since the 5th of January, right? These candles are not normal Japanese candles, sticks. I like this kind of candlestick oriented, kind of like a Japanese candlestick, because if you haven't noticed, I wear glasses and my vision's pretty darn bad. So what I like to do is use that really beautiful large footprint of a Japanese candlestick, and then I color code them whether they are bullish. We can have a down day that's still bullish in terms of the overall movement higher. We can have up days, right, that are still bearish within the overall trend. Think Boeing, right, for example. So these are things that if we get the little things right, we get the basic tools that we are making assessments about in terms of what we want to do. If we get that part right, we're going to be in good shape. And that's really it, right? Let's continue to focus on the long side. I prefer the S&P because the S&P is firing on more cylinders. And none of those cylinders really are heavily relying on tech. Remember, of the Magnificent Seven, and by the way, what is the Magnificent Seven? The Magnificent Seven are the number 1 and 2 top weighted stocks in the XLK, XLC, and XLY, and the number 1 weighted stock in the SMH. Those are all NASDAQ stocks. Those are all absolutely influential. When you lift the hood on the NASDAQ and you look at it, it's XLK, XLC, XLY, SMH. Now, when you lift the hood on the S&P, now you get the influence from financials. Now you get the influence from healthcare. Now you get the influence even from energy. And so let's not rely on just the Magnificent Seven being magnificent. They're not, right? We're down to 3 stocks of that 7 that are still moving higher. So these are little things that we talk about in the Sector Secrets Mastery because sectors matter, right? The sectors matter. So that's where we have overall this bullishness in the ES and NQ. Now, what about YM? Am I hating on YM? I am not. YM has been a wobbly uptrend. And what you're seeing on that large chart on the right is this year, 2024. We are trading 2024, not 2023, not 2022, certainly not 2020 or 2021. We are focusing the now environment. The now environment is an uptrend, preparing for a dovish pivot from the Federal Reserve, and we're in this overall election cycle, which tends to be a bullish factor. It doesn't guarantee an uptrend, but it's definitely a tailwind, right? Okay. So Dow is trying to punch up to higher highs. I don't want to short the Dow, but there are better places to look within the Dow. Lift the hood, you'll see industrials are a part of this narrative, as are financials. A lot of folks are surprised to find out that financials are the number 1 weighted sector within the Dow, not industrials, not transports, right? So let's keep an eye on those. So if you're struggling to figure out where should I be buying, because what we trade is more important than how we trade it. Follow through in financials has been better than follow through in, say, tech, right? Meaning XLK. Follow through in industrials has been better than consumer discretionary, XLY. So as long as we can start to pinpoint where the potential for follow through is, that's watch list building, right? That's, you guessed it, account growth. So check out that account growth video back at the Simpler Trading YouTube channel. And I walk through all of it. Those of you that are members of Sector Secrets Mastery, you already got the premium video where I went into a lot more detail. If you're in the Simpler Central room, I put out a very aptly titled video called How to Grow an Account, I believe is what it was called. Account growth, gang. That's the name of the game. All right. So as always, if you have any questions, type them on in and we'll go from there. Tom asks, thanks, Tom. Tom asks, do propulsion dots act as support and resistance? Oh, absolutely, Tom. So if the logic behind propulsion dots is a moving average cross, and moving averages in and of themselves are, in the context of a trend, support and resistance, then yes, absolutely. But propulsion, in my humble opinion, is actually better than a straightforward simple moving average or even a basic exponential because we're factoring in those moving average crosses, right? Now, if you've taken any of my previous classes, if you're in the Sector Secrets Mastery, I give you the propulsion dots. That's a tool that we've made available to members from the get. So do I have to sneeze? I don't. All right. Okay. So yes, it is support and resistance, but I would go one step further to say that moving average cross element and the propulsion dots appearing and disappearing is a much better way to view the fact that moving averages are not always relevant. There is an exception though. All right, Rog, what is it? There is one exception to the moving average being support and resistance outside the context of a trend, and that is the 200. And that could be the exponential or even the simple. You're going to find that it's going to be a psychological barrier. It's going to be a psychological level that we will notice is watched and is support even in a non-trending environment. So moving averages work better in trend. Almost everything works better in a trend because why? What do trends offer us? They offer us great follow through. Okay. All right. We have the end of the quarter this week. We have triple witching. Absolutely. This is going to be a wonky week. This is the end of something massive, in this case, the first quarter of the year. Now, the end of anything, the end of the day, the end of the week, the end of the month, the end of the quarter, the end of the year, these are all important psychological levels because this is when it is most, well, impactful to those folks who are managing large sums of money. I mean, hundreds of millions, if not more, under management. And they're going to determine what they want to end the quarter as. Remember, statements go out. This is a bit of a report card, if you think about it, right? Folks who are managing other people's money, there's a report card element to this. Yeah. And so what do they want to show their customers? They want to show their customers we're in all the things that are working right now. Yes, you're making money, right? Think about what goes on if you're managing money for other people, where at the end of a quarter or even the end of the month, there's a report card. How is my money growing with you Mr. or Mrs. Money Manager, right? So there's a lot of psychology behind things like that. Not to mention, um, how am I going to prepare for the next quarter? If we're seeing an overall uptrend, right? What does someone who has their money with somebody else want to see? They want to see that they've got the stocks, the sectors, the indices long, and which names, right? So think about that from the perspective of, if your job was to manage somebody else's money, I've done it. It's thankless. It's miserable. I'd rather just trade my own, which is what I do. Um, and think about the fact that their job is retention. And how do they retain their clients? By showing them, hey, you're in the right stuff. Don't worry. I know what's going on. You're in the right stuff. And that's much more the case at the end of the month, most definitely the end of the quarter, and absolutely the end of the year. All right. Next up is, do I see any significant correlation with VIX and so? All right, let's talk about market internals. I don't use any market internals. VIX is a futures contract to me. BLP, thank you for the question. VIX is simply a futures contract. It, like bonds, like corn, it's a futures contract. Market internals, and I'm going to say something that might short circuit some folks, but just let's listen to another opinion and then take from it what you will. Market internals are inherently wrong. Whoa, Rog, just put it out there. And here is why. So we've talked a lot about, and you can look it up, don't take my word for it. We've talked a lot about high concentration weighting, sectors, and stocks. If you look at the S&P, about 6 names account for nearly 20% of the S&P. Our market internals, tick, trend, any of them, including VIX. VIX is another internal. Are they calculated in the same way? They are most definitely not. So when I'm looking at a market internal, I'm not actually looking at an indicator or a market internal that's constructed in the way of the index. So they're measuring 2 different things. So no, I don't look at VIX at all. Now, as a general rule, if VIX is moving lower or higher, there might be some different opinion. But notice that VIX never trends. It just goes from one end of a range to another. So if VIX were a trending indicator that was correlated, to use your word, BLP, to the broader averages, shouldn't this be in a downtrend? I mean, broader averages are flirting with all-time highs almost every other week, right? So why isn't this in a downtrend? Because VIX is more like a gauge of high and low. And so no, my life is perfectly fine without the VIX. It's usually not accurate because, again, if lower volatility is indicative of, if a lower VIX, VIX, VXX, VX futures is indicative of strength, why isn't this thing in a downtrend? And that's because it's more of a high-low support resistance range. And that's it, right? So I'm not necessarily a big fan of the VIX. I pay very little, if frankly, no attention to any market internal. And I'll tell you this, I find market internals actually not only not helpful, I find them actually a bigger problem because it leads to faulty analysis. All right, next up, Eddie asked, do I recommend that we should focus on just a certain number of stocks and trade it if it goes up or down? No, Eddie. I mean, that's sort of true. Yes, I do believe in focusing on a fairly concentrated group of stocks. But when I say concentrated, I'm looking at about 2 dozen, maybe 3 dozen stocks. That includes sectors, ETFs, right? But as far as traded if it goes up or down, yeah, Eddie, we're going to wait for a dip. JP asks, how long am I usually in trades? It depends on the time frame. Thank you for asking. There are 3 time frames on my layout. Actually 4. The 4th is the weekly, but that's only for position portfolios. That's only for very, very long-term analysis. It cracks me up when traders are in a funny little space, right? Because the word trading and investing are not explained properly. If I'm investing, I'm trying to increase the number of shares that I own in a certain something, and I'm looking at holding this thing for years, if not decades, right? So investing and trading are not nearly the same thing. One is the accumulation of ownership, think Grandpa Buffett. The other is price differential. The level to which traders lean on things like the weekly and the monthly when they're looking at what's going to happen today or tomorrow or for the next week is hilarious, right? Because they're not measuring things based on the time frame and the time horizon that they're focused on. So I try to make that put that in the forefront. All right, what do you mean, Rog? If I'm day trading, do you think I give a rip about what the monthly is doing? If I've got a time horizon of 1 to 3 days, 2 to 10 days, does it really matter what the weekly is doing? It really doesn't, right? The weekly is only going to plot a new candle once a week. Yeah. So whenever anyone's looking at a weekly or monthly, they're looking at a huge time horizon, a long time horizon. What's going to happen over the next weeks, few weeks to months, right? And most of the time, we're here to do what? We're trying to either day trade, take advantage of today trading, or maybe we're looking at a time horizon of 1 to 3 days, short-term swings, or 2 to 10. So I've broken those down to the time frames that work best for me in those regards. 5-minute day trading, 1 hour for the short-term swings, daily for the longer term swings. And when I'm managing my portfolio, 6 months minimum hold time, ideally, that's where the weekly comes in. All right. So that's really what I'm thinking about. And where is that question? So as far as how long are you in trades, that's the first place to start. JP, that is the first and most important place to start. What time frame am I building this idea on, and what is the typical longevity of the trade based on that time frame? All right. Okay, gang. Gosh, that 20 minutes flew by. Great to see you all. Thanks as always for being here for Charts and Coffee. We've been rolling along with this show for about 3 years. So thank you very much for tuning in each and every weekday. I'll see you tomorrow, same time, same station. Be good to each other.